Good afternoon, ladies and gentlemen, and welcome to the Parity Group plc final results presentation for the year ended 31st of December 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you this presentation is being recorded. Before we begin, we'd like to submit the following poll, and I'd now like to hand you over to Matthew Bayfield, CEO, and Mike Johns, CFO of Parity Group plc. Good afternoon.
Good afternoon. Thanks very much, Paul. Hello, everyone. Thanks very much for taking the time to dial in and listen to what we have to say. I shall put the disclaimer up for you to read briefly, but I'm sure you're all familiar with these things by now. Let's start with some highlights for 2020. It's, I'm sure you're aware, been a very difficult year for lots of businesses. However, I'm particularly pleased with the performance that we've managed to generate during such an unusual time. We've remained financially robust. I think we have a lot of testament to our financial stability through having driven such an effective transformation in the last couple of years. We managed to return to an operating profit for the first time in 4 halves, and I'm particularly proud of that. And that's really all due to the cost savings and the operating model that we employed, which have driven far more operational gearing into the business, meaning that we can run in a much more lean fashion. We've got some strong working capital improvements, and Mike's going to take some time going through those with you, but that's led to us being able to secure a new asset-based lending facility, which gives us a lot of support and confidence going forwards for our growth ambitions. Part of our operational restructure has been heavily reinvesting back in technology into the business, and a big part of this presentation for me is talking you through what we've done there, so I'll come into more detail on that. And lastly, we are still net cash positive at the end of the year, with more detail to follow on that. So let's address the pandemic head on. First and foremost, I'm very proud of the staff and the way that they responded to this. We were very flexible at the start of the pandemic because we had a very lean ship. And that efficient operating model meant that we didn't furlough anyone, nor did we make anyone redundant throughout the course of the pandemic, which gives us a very clean position financially moving forwards. A driver for me in not furloughing people was to remain very close to our clients, and in the public sector that's really paid dividends. We've remained very strong in our relationships with the public sector throughout 2020. However, it did have a big impact in the private sector. New business went particularly quiet in 2020. I felt like a lot of companies were waiting to see what was going to happen and didn't want to make decisions about new initiatives or moving forwards. But I'm delighted to report that we've seen a real bounce back and an uptick in the market in Q1 of this year as people start to realize they're going to have to act to digitize their businesses as we move forward post-pandemic. To encapsulate or summarize the transformation plan, largely phase 1 is complete. The transformation is never really complete, but we have taken out all of the operating costs. We've completely redesigned the operating model, so it's moved away completely from a traditional recruitment model into far more of a sales-driven organization with an operating office in the backside. Phase 2 for us is taking that model and taking the slim business that we have and driving growth. So to that point, we are investing heavily in sales and marketing, and we continue to invest in technology that leads the way forward for Parity as the recruitment sector as a whole addresses the challenge of very, very slim margins. Where are we then today? How can I summarize the business for you? We have a team of 41 now, down from 140, across 3 locations in London, Manchester, and Edinburgh. We've got a very good top 10 leading revenue per head, with a clean CRM dataset of over 40,000 active contractors in the UK. And we know that's clean because through the process of rewiring the business with new technology, we had to update all of those records. And we're very confident that that gives us a strong pool of talent to work from. We have over 500 contractors on site at any one time. And although our private sector clients are often quite shy about wanting people to know who they work with, in the public sector, we can talk openly about the work we do for NHS Digital, the Her Majesty's Courts, the Office of National Statistics, the Scottish Government and Department of Education. In terms of the team, we used 2020 to refresh the board. I'm delighted to announce we have both a new non-executive chair and a new non-executive director joining the board in 2020, as well as 3 new senior members of the operations team in the form of Mike Johns as CFO, Sarah for operations, and Kevin for commercial. And Kevin joins us from Accenture, which I think really points out the change in this business and the strength of the talent that we're able to attract in, given the vision of where the business is heading. And let's touch on that. So, as you should all be aware, Parity is very focused on data. The world, as we see it today, is driven by data, and a lot of the top 10 companies in the world are, by one means or another, a data company. McKinsey's estimate the rate of data to be growing exponentially, generating trillions of value. The key part that we have to play in that are the skills that are required to turn that data into efficient, exciting opportunities for businesses, whether that's in generating new revenue or redesigning service propositions. But it all comes down to people. The rate of data expansion has far outpaced the ability of the workforce to be able to use it. That created an interesting opportunity for us as an executive team, where we see a shortfall in these scarce resources. What's the best way to deploy that into a market? Now, obviously, quadrant analysis, I understand the limitations. You could make them say anything you want them to say, but we looked at the market to try and understand what is new technology bringing into the resourcing sector? How can we be part of that? And where is it that we see an opportunity for us? So there are businesses that specialize in data, and they will go to market offering data skills, but they are not technology based. They are very recruitment orientated, around 360 recruiters. There are multidiscipline recruitment companies, of which you'll be familiar with lots of the names on there. And there are the large, usually Silicon Valley based tech platforms such as TopTal and Upwork. And the space where I think we can plow our own furrow is in having a narrow and deep focus on the data skills delivered and enabled through a tech platform. My estimation of that market size is significant. The global market is somewhere around 30 billion, with compound annual growth in the high 20s. Europe's the second largest market behind the US, and the UK is the largest market within Europe, with a very high number of estimated data roles. That creates, I think, a huge opportunity for this business to become market leading in providing those data skills on demand. And to be clear, when I talk about providing data skills, it's not just in a buy by the day or buy by the month. It's also buying a project, where if you're an immature data company, you might not know the type of person you need or the skills that you need. Therefore, you're looking for an outcome. And I see Parity as straddling those worlds. We very much offer you the talent if you are very clear on what you need, but we can also advise you through consultancy on the kinds of projects that are going to deliver the value you're looking for. Which brings me on to how we will grow. The 2 key elements of this business are the community of data experts and being known as the home for the best data people in the world. Adding into that is a frictionless buying experience for both the contractor as well as the client. And that's got to be delivered through more efficient technology. You add those 2 things together, and we become the #1 provider of data skills on demand. I'm going to hand over to Mike now, who's going to take you through some of the detail I was talking about around the financials.
Good afternoon, everybody. I'm just going to give you an insight into the financial highlights for 2020. There were 2 key factors that drove the financial numbers in 2020, the pandemic and the ongoing transformation that Matt's talked about earlier. At a headline level, revenue came down by 28% to 57.8 million. We've previously highlighted in 2019 in the report and this year in our annual report, the Scottish Government wind down, and that's had a significant impact on revenue, and I'll talk about that a bit more later on. That's also flowed through into external contribution, which is also down. At an operating profit, an adjusted operating profit before non-underlying items, we made £500,000 in the year. And that's down to the fact the transformation and the operating efficiencies that we've pushed through the business during the year. Cash has come down from 1.4 million to 0.2. And as Matt mentioned earlier on, I will talk in more detail about that as we go through and explain why that has happened. Moving on then to start talking about client income. The first thing to mention is that we've changed the way we segment the business to public and private sector. We continue to drive for data business and higher margin business. And as we focus on client specific areas, the change has been made to focus on public and private sector. Public sector delivering 75% of our revenues and 70% of our contribution. Private sector delivering the balance of 25%, but higher margin business delivering 30% of our overall contribution. Looking at the public sector first of all, as I mentioned before, the wind down of the Scottish Government framework has had an impact on our revenues and therefore on our contribution. During 2020, that impact was 1.9 million. Outside of the Scottish Government framework, we've seen other clients of ours, as they've changed their way of working with the pandemic, or they may have had to take on additional projects, we've seen other client revenue increase by external contribution increase by 0.6 million. In 2019, the Fast Stream project that we're working on for the UK government was transferred back into the UK government. And that was a high margin piece of business for us. And that has impacted on our margins in 2020 as we no longer have that business. So overall external contribution from public sector has come down from 9.8 to 9%. Looking now at the private sector, and revenues here have been hit by the pandemic. Our ability to seek new business in this market was curtailed in 2020. We also took the decision to exit from some very low margin private sector business. Our key clients, however, have remained strong despite some of them being impacted heavily by the pandemic itself. And we've retained good terms with them, they've paid on time, and they've continued with the projects that are important to them that we supply resources for. So overall, our margins for the private sector have increased up to 11.6 from 10.7% last year. And I want to move on and talk to you a little bit about what's happening underneath the margin level and what we've done within the business to deliver the operating profit of £500,000 at an adjusted level. This has been down to the transformation programme, which has seen us take out costs. In 2020, this was focused around the back office. And so improving our operating efficiency in the way that we, through finance, through our compliance functions and everything else. It's created a leaner organisation structure. And as Matt has spoken to already, we've invested heavily in technology. And we now have a new digital backbone. That will allow us to scale the business without having to increase costs at such a level. The net effect for us overall between 2019 and 2020 is a reduction in operating costs by 34% year on year. And that's the driver of the operating profit delivered for the year. As Matt spoke earlier, we didn't furlough any staff or take any support from the government during the pandemic, with the exception of a VAT deferral, which I'll talk about in cash. This means that the costs that we show you are our costs. There is nothing to add back when people come off furlough. We didn't furlough anybody. So our new operating model will enable the business to leverage the cost base in 2021. And we're expecting that to drive further profit growth. On the balance sheet, there are two key points other than cash, which I'll go to in a minute, that I just wanted to pull out. The first is, as a business that's been around for a long time, we have a defined benefit pension scheme. It's no longer open to new members and hasn't been for many, many years. But it does sit there on our balance sheet, and we have trustees that manage the investments and manage the pension scheme. Through the investments that have been made, the pension has now moved into a net asset position. Previously, it was a net liability position. And we would hope that those investments will continue to generate gains over years to come and increase that net asset position to a point where we will be able to look at a buyout from that pension scheme. Working capital working capital is critical in a business like this. And during the pandemic, all of our clients have continued to pay on time, and we've maintained a strong debtor performance. Debtor days were 14 in 2020, 2019, 12 days. So a very, very slight change, but nothing material. Our trade creditors are lower as a result of timing differences. The way we pay our contractors, some on a weekly basis, some on a monthly basis. But towards the end of the year, that can be impacted by the Christmas holidays and non-working days. And during 2019, there was an impact which meant that payments that would have normally, in a normal year, been paid in 2019 were actually paid in 2020. So the balance sheet held additional trade creditors over and above what we held at the end of this year. To explain that in a bit more detail on how that's impacted our cash, I provided the bridge below. So cash at the end of last year was 1.4 million and has dropped to 0.2 million. 1 million of that is related to payments from 2019. As I mentioned earlier, there were 700,000 of trade creditors that relate to contractor payments that were held over from 2019 and paid in 2020. In addition to that, there was 300,000 of restructuring costs, non-underlying costs, that were incurred in 2019, but paid in 2020. So on a comparable level, the opening position for cash would have been 400,000. We've benefited by 300,000 in the year from the VAT deferral scheme, and we'll pay that VAT back in instalments over this year. The operating business generated 400,000 of cash, and then underneath the line, financing costs and pension administration costs, etc., have been an expenditure of 400,000 in the year. In addition, as we've completed the transformation process and the restructuring, we've incurred 400,000 of non-underlying costs during the period, which have been paid out in the period as well. So we end the year with 200,000 of net cash. With no further transformation expected or non-underlying costs, we would expect, therefore, more money in 2021 to transfer through to cash. And that brings me on to the asset-based lending facility. We've recently contracted and signed a new lending facility with Lumi ABL. At the beginning of the year, the board decided they want to look at its working capital facilities with the upcoming renewal of the previous facility with PNC coming up in May. One of the goals was to make sure that we had a flexible facility that both supported the business as it is now and also its future ambitions. And we signed a new facility with Lumi ABL. The facility is for 9 million. The previous facility was 10 million. However, our current borrowing levels are not at those levels. Just to give you an idea, last year our highest borrowing was 4.4 million and our average borrowing was 1.6 million. So we are well within the facility limits there and expect to continue to be so. The agreement is for 3 years and we expect lower borrowing costs. The PNC facility had a non-utilisation charge. So any facility that remained unused, we used to pay a premium on it of 1%. We no longer pay that, so we're only paying for what we borrow. And we are paying 2% on our billed receivables and 2.9% on unbilled, so timesheets that have yet to be billed. We have increased borrowing availability. So our receivables and our unbilled receivables, we can borrow more against them than we could under the PNC facility. And that gives us greater flexibility to utilise the working capital. And it is something that we can take forward and we will use as part of our growth ambitions over the next few years. Just moving on now to the next slide. Sorry, that's neat. Final slide from me, just the trajectory of the business over the last 4 halves. External contribution has come down, and as I've talked about, the Scottish Government being a key factor in that as we've transformed the business and moved away from lower margin business. The pandemic has also affected us in 2020, although as you'll see, the external contribution, the graph, the gradient has shallowed, and we would expect that to grow in 2021 as we see new business come back. At a profit level, the impact of the transformation, the improvement in profitability of the business can be shown across the halves. We've moved from a loss to, in the second half, a profit before tax on an unadjusted level. And we would hope to continue that momentum into 2021 as we see business improve. Let me now pass you back to Matt, who's going to talk a little bit more about the outlook.
Thanks very much, Mike. All of this is pointed at delivering ambitious targets for us. We've been on a journey now for the last 2 years. It's just under 2 years since I took over, where we had to restructure the business, and you're all familiar with that story. Now it's about what we do with that restructured business. It's operationally geared in such a way that we can deliver more revenue for the same amount or smallly incremental cost. The two are now disassociated, where we don't have to incrementally up cost in order to deliver more revenue. That gives us a lot of confidence about our outlook. When you combine that with a proposition that's resonating very strongly in the market, even more so since the pandemic, as businesses realize they have to digitize at a faster rate than they thought they were going to, and have become much more aware around cybersecurity risks, we feel quite bullish. Now, I do have to caveat that with, I'm assuming that we are on a one-way trajectory out of the pandemic, but you never know this year as to whether or not things will revert. But confidence levels are very high, and that gives me these kind of numbers that I feel capable of putting out today. We're looking to grow 15% year on year. That's very ambitious and something the business hasn't done before, but I definitely believe that the demand in the market is there. And with our renewed efforts in sales and marketing, we're strongly targeting those sectors that have a requirement for those data skills. That comes with a 23% target of increase in external contribution as a percentage of revenue. That operational gearing coming through enables us to make more money out of an increase in that revenue. And ultimately, this is to achieve a healthy profit before tax margin of around 20%. I will take some time now to have a look at the questions, and I'll hand over to Paul to wrap up for us.
Fantastic. Matthew, Mike, thank you very much indeed for your presentation. As Matthew said, ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the team take a few moments to review those investor questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide your feedback in order that the company can better understand your views and expectations. Matthew, Mike, I know I haven't given you a great amount of time, but as you can see, investors have submitted a number of questions during the presentation today. If I could perhaps hand back to you to respond to those where it's appropriate to do so. May I ask you just to read out the question and give you a response? That would be fantastic.
Okay, well, there are a few, so we'll answer a few now, and then I think we'll give written answers to the majority, if that's okay. The kind of summary question overall is, where will growth come from? And that's a few different key points. I think that's quite an interesting one to look at. The growth in this business comes from the plethora and growth in data in the world in general, and people wanting to find a way to utilize that to better effect. That comes down to requiring skills. Those skills are a scarce commodity in this marketplace, and we want to position ourselves as being the number one route to accessing that scarce commodity. Therefore, our growth is intrinsically linked to the globalized information economy and the growth in data. Hopefully that makes sense. Obviously, the gearing that we've talked a lot about today is how we then make higher margin and more money out of that situation. Somebody's asked us to elaborate on how we have invested in technology and what that technology delivers. There's a couple of questions I'm mashing together there. We replaced our CRM system, our HR system, our pay and bill system, all of our back-end financial systems with a suite of products from a company called Access. It's given us the ability to seamlessly link between candidates, clients, timesheets, billing, and marketing. What that's also given us the opportunity to do is to look at building new technology on top of that platform. So that's where we will start to integrate things like artificial intelligence for candidate matching. We will start to look at portals for clients to be able to brief via some kind of chat bot. We'll also look at ways that we can engage with the community, and that might be through affiliate deals that we'll do with third-party training or accreditation. So it's looking very much at becoming a much more of a technologically based business built on the background that we've invested in this year. Again, summarising a couple of different questions. I would like to address our partnerships. So in 2020, we started 2 partnerships, both with Integument, which is now Deep Verge, and a cybersecurity firm called CyberGym. Both of those partnerships have been kind of quiet for us in that year, as we've seen most businesses have suffered with new business. We remain in good terms and close contact with both of those businesses, and are looking forward to jointly pitching for work in the future. I think that's covered most of it, but as I say, I think what we shall do is we'll give some written answers to the rest of the questions in the fullness of time.
That's great. Matthew, thank you very much indeed for addressing those questions. And as Matthew said, the company review all the questions submitted by investors today, and we'll publish those answers back on the Investor Meet Company platform. And Matthew, perhaps I could just ask you to give a few final words just to wrap up before we redirect investors to give you some feedback.
Yeah, I think if I leave you with one clear message, it's that Parity has got itself into a much, much better position than it's ever been before, and that we face into the future with a lot of optimism given the market that we work in.
That's great. Thank you. Matthew, Mike, thank you very much indeed for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected for the opportunity to provide your feedback. If you've accessed the meeting from our website, the feedback page will appear in front of you. If you've accessed the meeting via the link in the email you were sent, you'll just be asked to log back in to submit your feedback. It only takes a few seconds and will be greatly appreciated by the team. On behalf of the management team of Parity, thank you for attending today.